And there we go. Slight delays with some technical difficulties, but we're all
Jazz
here.
hands.
Magic.
Better late than never. Better late than never. Right. Gentlemen, Thomas, Sanjay, how are we doing?
Hello again.
What's good?
Yeah, all good. Can't complain. Well, the sun's out. It's getting warmer. Good news.
That it is. So if you are watching live, we are doing this month's episode of Money Talks. We get Tom from Partners Financial Services, there he is, online to chat with me and Sandy. Just very quickly, little update on what's happening in the mortgage world, what we're all finding, things that we're coming across, and some advice along the way. If you've got any questions at all or anything you want us to talk about, drop it in the comments. We'll answer your questions live or when we get back to them if you're watching it on replay. So, first things first. Are you still as busy as last month?
Yeah, even more so, if that was even possible. I said relentless last month, and it seems like relentless squared at the moment. I know you guys are the same. It just seems to be unstoppable. Yeah, absolutely crazy. As we all know, about 16 million different buyers for every house. So, that's mean that things need to be turned around quickly. So not only are there a massive number of people to deal with, but everyone needs everything done yesterday. So yeah, it's certainly busy still.
Good problems to have though, Thomas.
Yeah, absolutely. There are. Yeah, it's definitely a champagne problem. It's not a bad thing.
I like that. Very good. So we were just talking live off camera. One of the things that we are finding a lot is people are getting to the point, they find a house to buy, they apply for the mortgage, which is great, but some mortgage offers aren't even lasting 6 months at the moment. And what do? If they can't extend them, they're having to reapply. And as we know, rates have shifted, 0.5% up in the last month?
If not more, 6 months ago. Yeah, certainly at least that.
Yeah. So kind of piece of advice that we can give people, I think it's imperative that once they've got their offer accepted, they have to apply for the mortgage. We need to see a mortgage survey to get some commitment, to make sure that side of things starts rolling, and they're going to lock in the rate that's now and not in a few months' time.
Yeah.
Is there a way? Are there certain lenders that from the outset will give the option for extensions and things like that? Or
so all lenders have different rules on extending offers, and all lenders' offers are valid for different periods of time. So you know very much at the outset roughly how long this mortgage offer is going to be valid for and what the chances are of an extension if needs be.
Mm-hmm.
Like you say, you can't really get into a position where people aren't delaying applying for their mortgage when they've had their offer accepted, because ultimately that's going to put the estate agent in a bit of a worried position if they don't start to see some progress and to see some commitment.
Yeah.
But I think there just needs to be some consideration given to, if you're buying a property that's open chain and you're considering between two mortgage deals, for example, one might cost an extra £10 per month, but you know that you can get an extension on it for another 3 months if needs be, versus one that's £10 cheaper per month, but if it doesn't complete in the 6 months, you need to start all over again with a potentially much higher rate. I think there just needs to be some decision made about what's going to be the best thing to do. And it's always a case in certainly the work that I do where there's layers to what is the best mortgage product for someone. Is it the rate? Is it the fees? Is it the criteria? Is it the speed they can turn things around? And it's not really often in the last 11 years where I've been advising on mortgages that offer extensions has played a part in my advice about what lender I'm recommending.
That's interesting.
But suddenly it is, because if we've talked lots over the last couple of months about different situations where buyers are reaching the end of their mortgage offer, and we're talking about what happens if completion doesn't happen in that time. A lot of the time you need to reapply, and people's mortgage payments are going up by hundreds of pounds per month, 100, 150 pounds per month, because we can't get an offer extension and we need to choose a rate as it is today, versus where it was 6 months ago. So I think if you're having an offer accepted now and looking at different mortgage products, I think a question to ask your mortgage advisor is what's the process if we need to get an offer extension? Some lenders are very flexible, some lenders are very rigid. So a lot of lenders will say, well, we'll give you an extension, but you need to choose a new rate as it is today. We'll assess the case as it is new. We'll get new pay slips, new bank statements. Is that an offer extension?
It's not really,
you just applying again without the application? So yeah, I think that's the most important thing, is working out exactly where you stand with your mortgage offer. Lenders are busy at the moment. So if your offer expires on the 30th of June, you need to not ask for extension on the 29th of June. You need to get in there 2 to 3 weeks early to request that extension, because mortgage lenders are taking 2 weeks to process even the most basic, simple applications and requests. So it's just about staying on the ball, and ultimately a good mortgage advisor is going to do that for you. A good mortgage advisor is going to keep on top of your mortgage offer, know exactly when it expires, so can almost preempt the request for an extension and deal with your estate agent and solicitor to work out, right, is this going to complete in the deadline or not? If it is, great. If it's not, right, what do we do to either get an extension or put ourselves in the best position going forward?
Okay. And is it the fact that there are fewer lenders offering extensions from the outset, or is it just that we are seeing more people getting to the point now where we're going,
so it's never really been an issue. So mortgage lenders in general don't like extended offers. So for new build properties, fine. Pretty much new builds, you buy a property off plan, they get delayed, they could be 12 months in the future, you want an extension, no problem.
Mm-hmm.
Mortgage lenders' point of view is that really a non-new build house transaction or a remortgage should be completed in 6 months. That's plenty of time, really, in a normal world. Obviously, we're not living in a normal world, and they don't really like extending the offers because you're having longer to complete on a 6-month-old interest rate than you should have. So if you applied for a deal 6 months ago, that was 6 months' interest rate that you're now asking to have valid for a longer period. And also your income position might have changed. So you submitted pay slips and bank statements 6 months ago, and they say, I want my mortgage offer to be for another month. And that's why a lot of lenders will ask for up-to-date income proof and up-to-date bank statements, because that's a long time. A lot can change in that period.
Got the mortgage offer and then run up the credit card and
I think it's just a case that 6 months is a long time, and when you're taking on a big financial commitment like a mortgage lender is going to want to make sure that your situation is still the same. So, and that's why they all have different rules. And we talked last month about Nationwide in for example, given a 15-day grace period on a mortgage offer, but they won't extend beyond that. So you've almost got 2 weeks to get everything signed, sealed, delivered. If not, you start from scratch. And when you're a buyer, I think one of the most daunting processes is getting your mortgage approved. It's a whole new world. You haven't done it before, or at best you've done it once or twice before. Your pay slips, bank statements, it's all happening in a world that you don't really understand.
And everything hinges on just that.
Absolutely. Yeah, it's out of your control, isn't it? You know what I'm like, being a control freak, but it's out of your control. You're submitting your documents to someone else and say, there you go, and you don't really know what they're looking for. You don't really know, the percentage chance of it all happening. You've already done the hard bit, so having to do that again, it's just not an ideal situation. So I think, a lot of weight of advice at the moment should be given on flexibility to mortgage offers extending and keeping the rate that you originally reserved, because I think that's the crucial thing. In November, December, with people with 40-50% deposits, we're getting rates sub 1%, 0.99 5-year fixed rates. And now you're looking at 2.2, 2.3, 2.4 for the same deal. So that's over double the rate that you're getting. It's not your fault if the house if the chain doesn't complete in time. It's not your fault.
And I guess what are the options? You look for another property, but you find you're going to be spending the same, if not more money for a similar house anyway.
It's the same position, right? If you look for another house, more than likely that house is going to be open chain. That seller won't have started their search until they've got a buyer. You know what it's like. Estate agents won't let people through the door unless they've got a buyer agreed on their property. So you get another house, it's going to be open chain. Look for another lender. Again, rate as it is today. So yeah, it's really difficult, and yeah, I think a lot of weight needs to be put on the flexibility of a lender. Just like, you know, with you guys, we always say that flexibility is king. You got a buyer that's prepared to wait, blah blah blah. Again, with mortgage lenders, again, I think flexibility is king, and finding a lender that, yeah, okay, it might cost you an extra £10 a month on the mortgage, but knowing that you've got the option to extend it if needs be, which is happening more often than not at the moment, is something that I think needs to be paid a lot of attention to at the moment.
Yeah, absolutely. I think everyone involved in every part of the transaction is so busy, from the agents to the lenders, the solicitors, the surveyors.
Yeah.
I think all that's got such a knock-on effect to why transactions.
Yeah, and I think you've got an issue as well, is that a lot of banks certainly made changes to their processes because of coronavirus. Either they laid off staff, or staff were all working from home, or brought in, you know, whatever it is, and they're almost trying to. Then, you know, no one was expecting this to be like it is this year. So it's all a bit of a perfect storm to make things as busy as they are.
Yeah, absolutely. Okay, so for anyone that's joining us live now, drop us a comment, pop us a like, let us know what you think and what you would do sort of in those situations if you've got your dream home, but time appears to be running out. Do you extend? Do you start looking again? Up for debate. Sanjay.
I had a question posed to me the other day on my open house that was on last weekend. First-time buyer. There's basically this new wave of first-time buyers and a new wave of first-time sellers that are coming into the market this year, which we've definitely noticed it. And a lot of people are complete novices, especially first-time sellers who have been in their home for like 20, 30 years or never sold before. They've only just bought. And obviously things are a lot different now than they were 20, 30 years ago. Can you just explain, I think myself and Ellen know what they are, and obviously you do, but from a mortgage broker's perspective, the difference between a mortgage in principle or an AIP or a DIP or whatever you want to call it, as opposed to a mortgage offer, and also what the stages you have to go through?
Yeah, of course. So agreement in principle is essentially a glorified credit check. So it will be with a particular lender, let's say Halifax. You fill in minimal details about yourself: name, address, salary, any debts, and it will give you a figure of what it thinks that you can borrow. But the most important thing is that you don't need to provide any proofs to that lender to get that agreement in principle. So Sanjay, for example, you could walk up to Halifax or go onto Halifax website this afternoon, ask for an agreement in principle, tell them that you earn £1 million a year, and I know it's close to that, but not quite, and they would give you an agreement in principle for £4 million, let's say. So you'd have a certificate that says, Sanjay, great news, you can borrow £4 million. But do you earn £1 million a year? No, of course you don't. You know, you don't have to provide any proofs to be able to get that. You've just told the system that you earn that much, and for that, it's going to take you at face value. And a mortgage offer is going to be when you've submitted your full mortgage application and you've provided all the proofs to the lender that they need to essentially give you that mortgage with no further checks. So if you're employed, you'll have provided your pay slips, you'll have provided your bank statements, and usually you'll have provided your proof of deposit, whether that be from your savings or whether that be from parents or wherever, if it's a gift. If you're self-employed, you normally would have provided your tax returns, your business bank accounts, sometimes your company accounts, and that lender's going to look over everything as a human being to make sure that you've said that you earn £50,000 a year, Mr. Customer. Yes, I can see from your payslips that you earn £50,000 a year, so we're all good. So essentially, an agreement in principle is a glorified credit check, so making sure that you haven't got any defaults, county court judgments, missed payments, and it's just applying a simple multiple of your income to spit out a figure of what you can borrow. So you earn £50,000 a year. here's an agreement in principle, you can borrow £250,000, go and find a house. At that stage, there have been no questions in regards to your income. So, if you were thinking bonus, commission, overtime, these are all complicated aspects of income that every lender treats differently. So if you earn 50,000 and you've had a bonus of 50,000 that was an annual bonus, but that was only paid once, well, there's very few lenders that are going to take an annual bonus if you've only been paid it once. So if you've got an agreement in principle from a lender that, let's say, doesn't take just 1 year's history of annual bonus, but you've used that annual bonus, they've got no way of knowing that you haven't received that for 2 years. You're just assuming that they're going to accept it. And of course, the system's also going to assume that you meet the rules. So it's going to say, there you go, based on your annual bonus, no problem. But then if you go to convert that agreement in principle to a full mortgage application, and that lender's going to ask you for 2 years proof of your annual bonus, and you're going to say, well, hold on, I've only got one, then they're not going to be able to take it into account. So that's when you'll find it difficult to not get your mortgage offer, because the system is just assuming that everything that you said is correct. And as we know, mortgages are complicated products. There's pages and pages and pages of criteria of everything that you have to follow. It's very difficult to know definitively whether you do or whether you don't meet a lender's criteria. So agreements in principle, great. Estate agents for years have put a lot of value on them, because ultimately it does show that a buyer has at least taken a small but reasonable step in showing that they're looking to purchase this property. Whereas a mortgage offer, essentially, is signed, sealed, delivered. You've been through all the checks that you need to gone through. A human being's looked at it and they've said, we would absolutely lend you this money, no problem. So it's just a case of how much detail it's been looked at to be able to approve your application.
So basically, an agreement in principle kind of means absolutely nothing within reason when you're going to buy a house anyway.
Yeah, absolutely. Estate agents will often ask for them, and I will often get a call from estate agents to say, agreement in principle, blah, 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 blah. But like you say, really, does it mean a lot? No. And I think we've talked about this on a previous call, that even agreements in principle credit searches. So some lenders, when you do an agreement in principle, they'll only actually look at the past 3 years history. But when you come to submit your mortgage application, the full mortgage application will look at the last 6 years history. So if you've got some bad stuff going on in regards to your credit file that's 4 or 5 years old, an agreement in principle might not even pick that up. But then when you go to submit your full mortgage application and they do the proper credit search, that's when it might come up and begin to be a problem. So look, agreements in principle is great as a buyer because you know roughly how much you can borrow. Because I remember when I first started looking at my first property years and years and years ago, I didn't have a clue. Absolutely did not have a clue about how much I could borrow. It was a different world, admittedly, but still, when you're a first-time buyer, you just don't know how your income is going to be calculated. You read on the internet, there's a million different articles about how much you can borrow, who you should go to, blah blah blah, and it's helpful to have a guide, because you need to know whether you can look at a house at 300,000 or 500,000. An agreement in principle is going to give you that guide, but I think that's all it is a guide.
It's not actually factual basis. We're also seeing a new wave of business owners running their own business over the last 2 years with COVID and all of that. There's a huge amount of small businesses that are coming up through the ranks now. And obviously they're now looking to buy, they're looking to try and sort out a mortgage. I think you had one recently that we passed over to you.
Same as you. I've actually had lots. So maybe over the last 12 months, haven't done that many self-employed mortgage applications, as COVID was a bit of a difficult time for self-employed, but now we seem to be coming out the other side. There's a lot of business owners that are now looking to move or to get on the property ladder. And again, business owners, company directors is a little bit of a more complicated and a more specialist field for mortgages, because there's 2 different ways that your income can be calculated depending on how you want to do it. So I guess without going into too much detail, as a company director, the way that you'll normally pay yourself is via salary and dividends. So you'll take a salary out of the company and then you'll take dividends on top of your salary. And that's the way that maybe 9 out of every 10 lenders will calculate your income for a company director, is the salary and dividends, usually averaged over the last 2 years. However, there are lenders who will look at the company profit. So if your company profit was, let's say, 100,000, you only took 40,000 out in dividends because your accountant advised you that was the best thing to do. Whereas most lenders would work on the 40,000 dividends, there are some lenders that will look at the profit of the company, so 100,000 instead. And obviously, that's going to have a massive boost for some people where their company profit is much higher than the dividends that they've taken. And it's just all about individual approaches. So it depends on how the company's doing, the performance, everything going on in the background. And if the company looks good, then there are lenders that will look to use the profit instead of the dividends taken by the individual. And that could be a massive boost for a lot of directors.
Well, let's just paint an example, because obviously the first year of business is always going to be a bit difficult.
Yeah.
The amount of income and profit that you're probably going to get is going to be very different to the second year. So if you're trying to process a mortgage for someone and they've got, I don't know, 20,000 income in the first year of their business, and then 70,000 in the second year, or just coming up to like the 20th month or something.
Yeah.
What do lenders take into account? And are they looking at like the second year, or mainly the first year?
Yes. So again, the majority of lenders for self-employed people will take an average of the last 2 years. However, there are lenders that will work on just the latest year. So in your example, if you'd earned 70,000 this year, 20,000 the previous year, there are lenders that can possibly take that. That is quite a big jump to go from 70 to 20. But a lender in that example would probably want a letter or a form from that company's accountant that explains the difference and confirms that level of income is going to be consistent going forward. And if the company accountant is happy to put their name to say, yeah, no problem, 70,000 going forward, then it's likely that lender will work on that figure because they've got assurances from the accountant that figure is sustainable. So it's just all very much on getting to know the customer, getting to know the company, speaking to the accountant. And as I said, there are lenders that will look at this on a case-by-case basis and work out what figure they're going to use based off the performance of the company and of course, the figures.
Oh, that makes sense.
We've had quite an interesting question come in from Andrew. If you're an investor looking up to 400,000, are you better off buying one at 400 or two at 200? I guess he means if you've got 400 grand in cash,
yeah,
you buy one. Do you split that, spread your bets, or even do you buy four with 5% mortgage?
So my common response to this question is, I think it's better to have more assets that increase in value. So if property prices historically have always increased in value, I think it's always better to have more assets that are going to increase in value. So if you can have two properties that increase in value, and then potentially if they both increase in value, you could do what's called gearing in the mortgage industry. So you could use those two properties, raise the deposit for even more properties, go out and buy more, they increase in value, raise the deposit out of those, go and buy some more. So my thought, without getting into tax and what property prices are going to do, blah, 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 is that my advice generally is two increase in assets better than one.
Spread your bets, in other words. Fair enough. Well, there we go. Hopefully that answered your question, Andy. We've got plenty for you to buy if you're out looking. Okay, great. Well, look, we're coming up to the 24-minute mark now. Sandy, any last words of wisdom that you've got?
Nope, just keep doing what you're doing, Tom.
Thanks, Mel. Yeah, it's been really busy, obviously, speaking to loads of great buyers. That a lot of people, I think more than ever, are just really keen to take on as much advice as they can, which is really good. People are understanding that in this market, it's not always the highest offer that's going to get accepted. It's the buyer in the best position to be in the most flexible, who's willing to work to timescales and to what you guys can advise them, what their solicitor can advise them. So it's really good, and like I say, a real number of good quality buyers out there, which is really good.
Absolutely. Good. Well, if you've watched us live, thank you so much. If you're watching on the replay, feel free to ask any questions. We will come back to you and we will put all of Thomas's contact details in the description boxes below. So thanks for watching, and we'll see you soon.
Thanks. See you next month.
All right.